Hello and welcome to today's webinar, Introducing Netwealth. My name is Matt Conradi. I'm Head of Client Advisory here at Netwealth. I'm also joined today by Ian Barnes, who's our Chief Investment Officer. We're going to be taking you through some of the key features of the Netwealth wealth management offering and service, how we think about working with clients to help them achieve their goals and investing for them as well. We started the business just over 7 years ago now, with a focus on trying to keep the best parts of traditional wealth management, but also using technology to make us more efficient, more cost effective, and make things more transparent and accessible for clients. So what you'll see today is some of the ways we think about doing that and some of the technology we use that's available to you as a user to access and think about your own goals and what you're trying to achieve as well. So what I wanted to do was just cover a little bit of administration before we get into those different parts there. And the first thing is to say, if you have any questions, please do send those through. You should see a little panel where you can submit them. I know some of you have submitted them in advance as well, and we'll try and cover as many of the topics that were raised as possible, and we'll have a bit of time at the end for questions. If you have any technical issues today, please just do start by refreshing your browser. This normally fixes any issues you have with audio or video coming through, so that should solve those problems. So let's get started and start thinking about some of the ways that Netwealth is set up and our approach to working with clients. I'm just going to share a slide to look at that. So bear with me 2 seconds while I pull that up. So really the Netwealth approach is using that combination of technology and an experienced team to help you invest and review your portfolios and achieve your financial goals. We think that really one of the first critical things to be thinking about there is financial planning. What is it that you're trying to achieve? So financial planning is about understanding your current position today, looking at what your goals and objectives are, and planning forward about how things might evolve, what your savings might be, what your assets might do, and how you might meet those different objectives. And everyone has a different set of financial plans. And there's no one perfect plan. We need to understand a range of different outcomes to go through. And we have advisors on hand to help you with this. So whether that be on a guidance basis, where you're just getting some helpful information and looking at our tools, which we'll look at in a moment, or getting full-blown financial advice as well. So recommendations about exactly the right things to be doing in the context of your situation and your goals, whether that be optimizing for tax or looking at different risk levels as well. Once you've got your plan in place and you understand how you want to start today, we have the investment management team, that's Ian heads up, to help us think about how to implement those goals and how to invest to achieve those goals. So most financial plans will have some combination of cash, some combination of investments, and perhaps some, we call them pot 3 assets, things like property and so on, that will all play into your goals to achieve for the future. What we then do at Netwealth is try and think of the best ways we can to give you better net returns. We want to do things like keep costs low, take advantage of tax wrappers and allowances where possible, so that we can give you the best possible outcomes, which means it's most likely that you'll achieve your goals going forwards, irrespective of what happens in markets as well. So that's our approach: focus on financial planning, offer expert investment management as well to help you implement your goals, and wherever we can, do the sensible things to make sure we get better net returns for clients, and it makes it more likely that you will achieve your goals going forwards. So when we thought about Netwealth, one of the questions we actually got in was what differentiates Netwealth from other traditional wealth managers that you might be aware of. And some of the things we've tried to put together into a modern wealth manager are exactly the same as you would expect at a traditional provider. We have expert advisors on hand. So they focus on doing the things where we think a human is most useful. So that might be the investment process. So Ian and team have a completely human-led investment process. They might use data and information coming in, and Ian will touch on that a little bit later on. But the aim is to have humans making decisions about investment choices and how to adjust portfolios through time. We've also got advisors to help you think about setting your objectives, assessing your risk, or being more tax efficient as well. And they're on hand to help you make sure you avoid some of the pitfalls as well. So that might be avoiding behavioral mistakes that might be there, that can all happen to us all. Emotions take over when it's our own money. And then we use technology on the other side of things to help us do this efficiently. So that might be cash flow modeling, and you're going to see some tools in a minute where we can think about modeling thousands of different paths of outcomes and returns and different cash flows for you into the future. We can do things automatically, like making sure we use your tax allowances as well. And technology really helps us to be more transparent, so you can understand what's going on. You can get more tangible outcomes for what's happening with your wealth, and keep the cost of investing as low as possible. through time. We think by combining these different elements, you'll have clearer financial plans, you'll get better performance, and that's what makes a modern wealth manager versus perhaps the more traditional approach. Whenever we're thinking about financial plans and investing, we like to think about the controllables and the uncontrollable elements of investing. And what our whole setup is designed is to think about controlling the things that you can control and modeling and understanding for the things that you can't control. So I thought it would be useful to just lay out what we mean by that. What are the things that we're trying to control and what are the things that we have to accept that we can't control as well. So if I think about the uncontrollables, this is things like how long you're going to live, how long you're going to need your cash flows for into the future. We can't control that, but we can model for it and understand the impact. Inflation, hot topic right now, and I'm sure Ian will touch upon it from an investment perspective, but we can't control what inflation will be, but we can model for the impact of higher inflation. What does that mean for our investments? What does it mean for our income needs in the future? And then we also need to think about things like performance. We can't control market performance. I can't say for you with certainty what will happen next week, next month, or next year, but I can definitely help you understand what the range of outcomes might be, help you understand what the potential upsides and downsides and drawdowns could be for a given level of risk, so you can make a more informed decision about what you're comfortable with and what you need in terms of risk and return to achieve your different goals. So those things we can't control, but we can definitely help you understand the impacts of them so you can make more informed decisions. The things that we can control and that we really focus our business on is making sure that if we are going to invest, that we're not trying to market time. We want to have time in the market, not timing the market. We know that it's extremely difficult to go in and out of markets and get that right consistently. So what we want to give you is efficient market exposure over time that will help you achieve your goals. To counter that, the risk of markets, we can be more diversified. This helps us smooth the path of return by having a whole range of different underlying investments, different markets, different currencies and regions that will help us make sure that the path is not as bumpy as it might be if we had one stock or one individual investment. And that will help us be more likely to achieve our goals, particularly if you're thinking about drawing down, where volatility, the ups and downs that you might experience have a big impact on your ability to keep that income into the future. Something that we know we can control and that we can definitely make sure is as good as possible for ourselves is being as tax efficient as possible. So we don't get that many things from the government in terms of tax efficiency, but it's making sure we're using pension contributions, ISAs, withdrawal strategies about where you take money from at different times in order to make sure you don't go through your allowances, automatically using your capital gains tax allowance, those sorts of things. If we can do all of the right things there, it will have a tangible impact on our outcomes and therefore our ability to achieve our goals as well. And the final thing that we can really focus on that's really important is minimizing fees and the cost of investing. We know that the hurdle you have to beat every year to get a positive return is your cost of investing. If you can minimize that, if you can keep your fees as low as possible, it's going to be easier to get a positive return going forward. So we really focus on every layer of the investment process, every layer of the overall wealth management process to keep the cost of investing as low as possible, because we think that will have a much bigger impact through time when we compound that up. So everything we're doing is about helping you understand the uncontrollables and what they mean for your choices and what you're trying to achieve, and then controlling those different elements that we can control through time to give us a better chance of a better outcome. What I wanted to do now was start to think about a bit of a case study and look at some specifics. So what I'm going to do is actually pull up our online platform, which is called Netwealth, and this is where we can start to look at a specific example of what you might want to do. So where you can think about what your current position is today, and I'm just logging into that platform now in the background, and then look at what might happen in the future as well. So let me share my screen and we can see the position. And this is something that you can log into yourself. You can all access this if you register at my.netwealth.com. You can then see this section and you can start to do this for yourself through time. You can also speak to an advisor if you want to get a sense for how to make the most of this. But when we think about those stages we discussed, financial planning, investment management, better net returns, the first thing on financial planning is understanding your current position. And our wealth tracking dashboard is designed to help you get a sense for where you're positioned today, to look at the amount of assets you have in pensions, ISAs, taxable investments, and also what the underlying asset allocation is. So in this dashboard, you can then track the value through time and get a sense for what your wealth is doing. And that might be across multiple different providers. There might be Netwealth portfolios. There might be different providers that you have. Maybe it's workplace pensions, maybe it's cash. And in each individual one of these, you can drill down into those breakdowns and see the underlying funds. And what we do is we go away and we look through the funds. So if you have a multi-asset fund like this, a Aviva Schroeder managed balanced fund, for a lot of people, and myself included, it's hard to know exactly what that's allocated in. What we do is go away and work out what the underlying asset allocation is, because the underlying asset allocation will drive the risk and return characteristics. And so if you don't have a sense for how you're positioned today, it's hard to know how you should be positioned going forwards. And once you have that picture, it's great to be able to check back in on it, see how things are progressing. And that gives you the starting point, a snapshot for your financial plan. What the other part of our tools is the planning side of things. We can then look into the future. What we've done is taken the same underlying analytics tool that we have, that we use for all our advisors to give regulated advice as well, but we've exposed it to users so that you can log in and look at your own plans into the future here. So someone today who's age 49 is looking about saving towards retirement at age 60. They want to target retirement income of £5,500 net of tax. And they've got some different assets to put aside to that. They've got pensions, they've got ISAs, they've got the general investment accounts. And these have all been pulled through from that tracker of those assets. And then they can see how achievable that goal is into the future. And we're looking at a range of different outcomes into the future. And other sub goals they can put in place. So in here, for example, they've talked about giving a gift as a one-off gift of 50,000, perhaps to a child for a deposit. This is helping them understand whether that's achievable or not. It's a kind of real life problem that we deal with clients all the time. I want to be able to help out my children, but what will it mean for my retirement? A second goal, for example, here is paying off their mortgage in the future. And then their retirement starts. Perhaps they have some defined benefit pension income or state pension income that's going to kick in as well. And then this chart shows us a range of outcomes from strong, average, and weak scenarios. And what you can do is get a snapshot of whether you're on track or not, a summary of where you're positioned. If you want to speak with an advisor, you can always just click on the link here and book a time directly into their diary. That will set up a video call for you to have with an advisor to go through the plan and talk about it. There's also resources on things like how to think about planning and what you should be doing as well. You can then refine these plans. So this person might look at that and say, look, it looks okay, but maybe I need to think about what else I could be doing. What could I be doing to make it better into the future? Well, I'm making some pretty chunky pension contributions already, so that's already a factor. Perhaps there isn't an ability to change the level of contributions. Maybe I'm making full use of the annual pension allowance there, the 60,000 that could be used, because that's very tax efficient. Making some ISA contributions, so that's also a sensible thing to be doing. So maybe it's not about contributions in this case, it might be about changing the goal. So they can look at, for example, changing their retirement date to age 62 and see what the impact of that is. If they go back to the projection, it starts by showing you the original position. And so you can remember where you were, and then you rerun that projection and see what the impact of making that change is over time. And this is going to recalculate all of those different future cash flows that you want in terms of the net income being inflated forwards, and then see the impact of changing that retirement date. And that's had a pretty sizable change. So instead of the money running out before age 95, the money's now going to last beyond age 95, and actually you're going to have about £1 million on average remaining. Now, because we are looking far into the future, it's sensitive to these changes, but that can be something that can help you make a more informed decision. You may feel that deferring retirement by 2 years is something you're prepared to do versus perhaps reducing the level of income you have, or saving more before that point, or taking more risk. All of those different choices can be modeled and looked at. And if you want to do this with an advisor, you can also go through this with them to talk through the choices, to understand the different parts as well. But the tools are designed to give you an input and an understanding of what's happening, so you can think about what you need to consider, so you can make more informed decisions about what to do in the future as well. So you can see there, you have these choices about what you might want to do, how you might want to implement. This might be pulling through things that you have with Netwealth across the risk spectrum, and we're going to talk about that in a moment, or it might be pulling across things that are positioned elsewhere. If you want to have some help with implementation, Netwealth is on hand to think about those investments. So if you've looked at the wealth tracker and you feel that you're not quite sure what's going on in your underlying portfolio and you want to make sure it aligns with your plan, what you can do is get in touch and we can then help you think about those different parts. And in here, there's always more information about Netwealth, how we invest, what we do. There's lots of detail about performance, for example, and fees and so on, and we'll touch on that a little bit later. But you can also go through to more of a dashboard about us and some details. If you register, you'll get given access to a specialist, and that specialist is on hand to answer any questions for you at any time. Again, you can book in calls directly with them, and you can always ask questions at advice@netwealth.com as well if you have those as you go through. But if you wanted to get started and open an account, you might want to have a look through the different moving parts, and we can go back to the basket here and think about some of the specifics. What I'm actually going to do is go to here and think about adding a new portfolio, because we're now thinking about implementing. So maybe I was thinking about the pension, for example. I want to think about a 10-year time horizon in a pension account. I want to model for this specific goal. So instead of all those different moving parts of the pensions and the ISAs and the taxable portfolios together and what that might be, I'm now looking at one particular goal, and I'm thinking about 250,000 allocated in a pension. I'm not going to make any contributions to this pot. We have these 7 different levels of risk. What I'm going to do now is hand over to Ian, who's going to talk a little bit more about how we think about those different risk levels, how we build portfolios and adjust them through time as well, because this is really the implementation phase of how we help with investment management in there across these 7 different risk profiles.
Great, thanks, Matt. I guess the things that we would want to focus on the investment side is really helping people to understand the type of approach that we take when looking after everyone's investments, all the way from designing the original allocations, but then feeding through to what we do on a day-to-day basis. And as Matt said, the process has been designed very much in sympathy with the wider intentions of the business. So we're looking to make sure there's a lot of efficiency and control all of the things that we know that we can do. So perhaps, Matt, if you think about how we can go through and look at a particular risk level on a given portfolio. So the system will help you understand the types of exposures that sit behind a given risk level. So the pie chart on the left-hand side talks about the overall asset allocation that builds up into your portfolio exposures. Here we have just under half of the portfolio sitting within equity markets and others in more risk-reducing assets such as fixed income, as well as some commodities which help us protect against volatility of inflation, which of course is a key issue at the moment. When we're thinking about how to put together these portfolios, we're always very aware that you need to be able to understand the way that a portfolio will behave through a range of different periods and what it's designed to do in the context of the overall range of portfolios. So we run 7 different risk profiles in each of 3 currencies. And if we look at the middle bar charts here, you can see the way that we try to show people how a portfolio might behave in good times, but also in bad times. So looking back over 25 years of history, what is the worst period of performance that this portfolio might have seen over a given 12-month period, and conversely, what the best is. And as you would expect, as you move from risk level 1, our most cautious portfolio, up to risk level 7, you can see that the range of expectations will increase. So it's important for clients to understand what the overall portfolio experience is likely to be at. And if you can see, another way of picturing that on the right hand side is to think about the individual years, what this portfolio might have seen in different environments. So clearly, as you're up towards the upper end of our risk spectrum there at risk level 7, there's some significant periods of volatility, but in aggregate, the experience has definitely been more rewarding, because over time we would expect these more ambitious portfolios to deliver higher returns. So for a pension fund allocation, this might be more appropriate because the period of which you're investing for might be that bit more extended. Perhaps we might go to the slide deck now, just to be able to put some of these things in a bit more context. So our approach is a combination of what people think of as active management and passive. And there are three components really. The first and biggest contribution to the risk being taken within portfolios and the returns being generated, what we call our strategic allocations. And these represent our view on what the best mix of different asset classes are for a given level of risk for which clients could rely on to deliver on their investment objectives. So if you were to invest in a portfolio, go away and do your day-to-day activities, whatever you find more interesting, and come back in 20 years' time, this would be the best estimate of how you should be positioned. Now, in reality, we think that it's clearly important to keep a view on the way that different asset classes are changing. And that's over on the right-hand side, is thinking about the cyclical positioning. If we think that there are particular risks embedded in a strategic allocation for a given portfolio, and we think that we can mitigate those, then the investment team will act on that belief. And these are typically risk-reducing measures designed to smooth that path of returns, which has a goal of making sure that clients have a bit more confidence in the market risks that they're taking. Now, we've spoken a little bit about keeping fees down, and efficiency is always at the forefront of our minds when investing. And a key part of that is the scalability of the platform that we've developed, whereby every client's portfolios are run in a very similar way, and indeed for every given risk level portfolio, different clients' portfolios should look the same. The second part of the efficiency in keeping fees down is by investing in an efficient way ourselves. And to that, we primarily use what are known as passive instruments. So exchange traded funds, which typically track our chosen market indices, are selected rather than us trying to decide particular stocks that can beat given benchmarks. And the key point there is that fees are kept down. We'd rather take those market returns, building diversified portfolios, and deliver a greater percentage of those market returns as much as possible, and let back to the client and let those market returns compound that much faster. So it's a key part of how we think about investing. Perhaps we can move on just to give a snapshot of the asset mix as a whole. So here again, we look at the risk level portfolios going from left to right, risk level 1 across to risk level 7, and you can see that the dynamic is very much one changing, going from lower risk assets such as cash and fixed income asset classes across to the equity mix. We think about currencies separately. So as we move up the risk spectrum, we're transitioning from a predominantly sterling-oriented exposure to a much more diversified portfolio mix. But it's always done in a thoughtful way. So for instance, from a strategic level, we've been pretty unsure as to whether euro currency exposure will actually deliver added benefit to portfolios. So we invest in European equities on a currency hedge basis, whereas we like the exposure that the dollar gives you. Perhaps again, moving to the next slide. This gives a sense of the breakdown of a given portfolio. So this is again our risk level 5 portfolio allocations. And on the left-hand side, we can see the breakdown of some of the asset classes that we invest in and the instruments that we favor at a given point of time. So even though we're investing in a passive basis, there's a good level of granularity, and we have intended exposures that we think we can take, we can offer exposure to clients in an efficient way. The mix of those assets will change through time, but the overall aggregated risk of a portfolio is going to stay pretty consistent and true to the overall risk level allocations. So in the interest of time, perhaps, Matt, you can move to the next slide. What we'll touch on is the experience of portfolio performance. We've just hit our 7-year anniversary of performance, and we've been pretty pleased with the returns. This is the total returns of our sterling portfolio range, and as you can see, the returns are internally consistent. And by that I mean that you don't have the returns generated by different portfolios overlapping each other. As you would expect, if you're running things in a consistent way, you'll find that all portfolios behave in a way that's appropriate for a given risk level. The more ambitious risk levels have experienced more volatility, but they've delivered greater gains at the same time. And to try and put those into context, we think about what they've done versus our peer group of ordinary wealth managers within the UK. And on the next slide, you can see the experience of the Netwealth portfolios in dark blue versus the peer group, which you show in grey. And we're quite happy that we've been able to generate about 1 to 1.5% to 1.75% per annum outperformance of the peers over time, which really compounds quite nicely. And the rationale behind that are the key focuses that I mentioned before. The first one is building a sensible, diversified portfolio of assets that can respond in different ways. That's our strategic allocations. Making adjustments through time to make sure that portfolios do okay in choppier environments. But the overarching tailwind that we've received is by keeping that laser-like focus on costs. So investing in the most efficient assets that we can find to deliver that market exposure. Before handing back to Matt, I was just going to give a little bit of an update on what we're thinking about the world at the moment. So here, as Matt said, inflation really is a key focus at the moment for us. So everyone is looking at where we are in the interest rate cycle. And as my colleague Jared Lyons has framed it, you're looking at whether there's going to be a pause, a peak, or a pivot in interest rates. We had the US Federal Reserve meeting yesterday where they chose to pause in their process, and the language around what they're doing was particularly important. We've got the European Central Bank meeting today, and so we're going to have their decision on interest rates coming as well. Now, European countries, including the UK, I guess, are that much bit further behind in the cycle and a slightly different inflationary challenge than the US. So we expect that interest rates there are going to keep on going a little bit higher. We think that the dynamic between different countries is really going to come into focus later in this year as we reach the end of the global interest rate cycle, where each country is in the stage and their thought process about how they want to address the inflationary challenge with rates already quite high is going to be really important. And to that point, it's really important to remember that all markets are not the same. Different equity markets have different characteristics. So the US has been a long time outperformer and supported by a more resilient economy and this small cohort of consumer technology stocks which have been doing really well. What that means, however, is that the valuation opportunity is very different. The US is, as a market, is reasonably overpriced, but that's focused within a small group of stocks. There is value in other parts of the US. In contrast, the UK has really been an unloved asset market for a given period of time. We've seen a lot of volatility within the bond markets in the UK as interest rates have been forced much higher. What we're seeing at the moment, quite interestingly, however, is that sterling is actually rallying quite strongly. So people are not seeing this as a sign of domestic weakness just at the moment, but just reflecting the fact that higher interest rates are going to give sterling deposits a bit more, a bit of a higher return. So people valuing the currency. The UK equity market itself is pretty cheap, dividend yields of about 4%, and when you look at the price to earnings ratios, they're at about discount of about 25% what they usually are. So we think that there's room for upside in the UK once people have a little bit more confidence about the strength of the economy. As things stand, there's not been a recession just yet. I think we think that the likelihood is that you carry on getting pretty stuttering levels of growth though. So we need to have a catalyst to get a bit more confidence of increasing our allocation there. The last point I was just going to leave you with is that, as always, we just try and focus on the fundamentals. So making sure that we've got a diversified portfolio to offer clients, having some assets that will respond to changing environments, whether that is fixed income, which is increasingly attractive with higher levels of yield and falling levels of inflation, or whether it's commodities and gold to provide a bit more protection if that inflation story becomes a little bit unleashed again. Efficiency is always at the forefront of our minds. So making sure that we're keeping our costs down in terms of our investments, but also in the structure of the team and how we can make everything that we do really scalable to pass on all of those returns back to clients. And the final point is flexibility. That in a changing world, it's important that you do have people who are looking out for client assets and making sure that there's decisions being made on a day-to-day basis. Matt, I was going to hand it back to you then, and then perhaps see if there are a couple of other topics or if it's time for some questions.
Great, thanks, Ian. Yeah, there's a few more topics we want to cover, but do think about questions. So please, we've had a couple come in already. Please keep bringing them in, and we'll try and cover the topics, as I say, or we'll answer them more specifically. So we've talked so far about the financial planning and investment management. What we wanted to show you now is how we can think about getting those better net returns, to controlling those controllable elements, but also making it tangible for you, so you can see what's going on in the different setups that you have and understand your portfolio. So what I wanted to do now was show you what it's like once you are a client, and show you a picture of a specific portfolio and what our platform does, and to give you more of a sense of what's going on. So I'm going to share my screen again and show you that picture. So here we go. Let's look at the picture. Once you are a client, we have an online dashboard that allows you to see what's happening in your portfolios, give you an insight to the individual parts. So you can keep that wealth tracker and wealth planner that will bring together both net wealth portfolios and external ones. If you want to drill down into your net wealth investments specifically, which might be all of your things or it might be some of your things, you can do that here in the My Account section. You get firstly a dashboard that gives you a sense of what's going on, gives you updates on new features, tells you if you need to review your portfolio. So annually we'll ask you to review your goals, make sure you're doing the right thing, and then we'll assess whether we think that's suitable for you or not. And you can see things like your returns as well since inception. You can always get a full breakdown of that information, so you can see the underlying assets you're holding, the investments, the asset allocation. You can see things like currency breakdowns, which I know what Ian was mentioning before, of your different assets. You can see overall performance, and you can see that both on a time-weighted return basis. So this is a 12-month period for all my accounts, up 7.3%. And how does that compare to, say, corporate bonds or UK equities? And you can change the different periods, or you can also see that on a change in pound value through time. So getting a snapshot of, okay, over the last 12 months, it's gone up 109,000. That's because I've put in 39,000. Investment return's been 71,000, and I've paid fees of £2,000. We think transparency is one of the great things that technology can bring, giving you this information in a really tangible way so you can understand what it actually means. Some platforms will just show you the change in value, and that's because of the deposits that you've made rather than the returns that have been generated. For those of you that want more detail as well, you can actually get a breakdown of all the individual positions and what the returns have been against different asset classes, and whether it be dividends or capital gains as well through time. which is great to see. You can drill down into individual portfolios as well and see returns for those different parts. If you think about the plan, it's made up of your overall goals and then individual goals that you might have. So let's take this person's ISA. They've chosen it to be invested at risk level 5. We can look at the reviewing that goal as well. So you can come back to that modeling for an individual portfolio and understand the context of whether you're achieving your goals or not. The other things that we can control, we talked about before, was things like tax efficiency as well. So we have a tax allowances and services dashboard where you can go in and make some elections to try and make sure that you are being as efficient as possible. So for example, you can say that you want to do a general investment account to ISA top up. So this will automatically move money from taxable investments into your ISA. You can make that on an annually recurring basis, so you don't have to do that scrabble at the end of the tax year in the last couple of days to make sure you get your money moved across. We'll do this automatically for you straight away in the new tax year. Or you can sign up for our capital gains tax service where you can target using your full allowance, or you can set a specific level of gains or losses you'd like us to target. Perhaps you've got gains elsewhere you want us to try and offset with losses, and we'll do that at the end of the tax year for you as well. There's also a host of other resources and information that you can access, and you can always talk to advisors, getting financial planning advice, getting just guidance. Maybe it's about specific things of advice around pension contributions. You can pay for a package of that, and we have lots of choices when it comes to advice, whether that be an ongoing basis, or you want more proactive service from someone on a regular basis, or you just want to pay for a one-off review, a plan. And we'll shortly be launching a guidance service as well, which will give you a structured and personalized guidance session to go through the things that are most relevant for you and a partner as well, if that's relevant for your needs. So you can get some help around how to be structured, what the right things are to be doing, so you can be as tax efficient as possible going forwards. We also can do things like instruct transfers as well. So pension transfers can be instructed online. Once you've input that transfer, the team will take care of everything, all the administration for you, make it as seamless and painless as possible. Pension ISA transfers as well. Unfortunately, lots of providers require forms there, but we will pre-fill the forms for you, make it as easy as possible. If you want to do bank transfers, you can do that through open banking, or you can just send payments to us. Something important to note here from a credit risk perspective, Netwealth doesn't hold the client money. It's held by a third-party custodian, which ring-fences it from Netwealth, keeps it completely safe and separate. So there's no credit risk to Netwealth with your investments. That means that if something were to happen, you can get those investments back. So we never hold your client money. We're just investing the funds for you and holding those individual underlying securities is quite an important part to be aware of there as well. So that's the online platform. I'm conscious of time, so I want to just cover a couple of other things as well that we can see here, as well as take questions. And it's great to see even more questions coming in, so please do keep those coming through. If we don't manage to cover your question, please do not worry. We will try and come back to you individually and look at that as well going forwards. So what I'm going to do now is just talk a little bit about fees. So I talked about controllable elements, things that we can control, and we really believe strongly that the cost of investing is something that you can control and you should be trying to control. So at Netwealth, when we think about fees for investing in investment management, we try to make it as comprehensive as possible, and we've laid out here that the Netwealth investment management fee covers all of that discretionary decision making about whether to have commodities or hedging your currencies or moving from Japanese equities or so on, and that Ian and team are doing at the different risk levels. It includes that third-party custodian, so that ring fencing of assets, the safe custody of them as well. Any transaction charges, whether that be foreign exchange or implementation trading or so on, any applicable VAT, as well as giving you the reporting, the platform, the tax reporting as well. So we produce tax packs where relevant, or pension contribution certificates, so you can do your tax returns. That's all included in the Netwealth management fee. And if you are at the minimum investment of 50,000 up to 250,000, that's 0.7% per annum. There are costs of the underlying funds, so we try to keep them as low as possible, but even with passive funds, there is going to be around 0.3% on top. Now, this will vary, so sometimes it will be a little bit less than that, but we quote 0.3% to try and give us the flexibility to be able to invest in different things like credit that's going to be hedged back to different currencies and so on, which can be a little bit more costly. So the total cost of investing between 50,000 and 250,000 would be 1%. If you go over 250,000 to under a million, then actually that everything drops. So it's not that the first 250 is at the 1% and the next is the lower rate. Everything would drop down to 0.55% for the management fee and all in 0.85%. And if you're over £1 million across all of your different accounts, then it would drop to 0.4% for the Netwealth fee and 0.7% all in. Something I should talk about here is an innovation we've been able to use from technology is the Netwealth network. And this allows you to bring up to 7 people into your network. They're completely separate. They can't see each other's assets and so on, but we look at them together for fee purposes. So if you open an account and you have £500,000 in maybe your ISA and a pension, and then you invite a spouse and they bring another £300,000, and maybe you invite a friend who brings in another £300,000, together you've got £1.1 million there. Individually, you would all have been at the 0.85% fees, but together you're over £1 million and you all drop to the 0.4 or the all-in of 0.7%. So you get the economies of scale together, but you're completely separate, have your own goals, no one can see each other's accounts, but it can be a really nice way to drive that efficiency, which we think is really important to making you achieve your goals and something that you can control. The other thing that you might want is financial advice, but we know not everyone needs it all of the time and wants it. So we didn't want it to be baked in that you're paying an extra 0.5% or 1% per annum, as you might find with some traditional advisors for advice all the time. So we give you a couple of different ways of thinking about that. There is one-off advice, and this can either be an agreed piece of work, maybe it's a retirement plan, or looking at whether you can afford to give assets away, and you want some specific recommendations more than just using the tools yourself and talking to an advisor, then that's charged for on an hourly basis at £200 per hour, and we'll agree an estimate with you in advance. We also have one-off advice in package form. So if you want a pension contribution piece of advice, that's, for example, £350, and that might be something specific that you want some advice on an ad hoc basis. The other alternative is ongoing advice. That's 0.35% per annum based on the assets under management. And that is where we're going to have regular check-ins with you every 6 months to review your circumstances, make recommendations, and be a little bit more proactive in terms of the advice that we're offering you. So for some people, that'll be exactly what they need. And for others, they don't feel they'll need that level of ongoing servicing and advice. But we want it to be available for you to pick and choose the level of advice that you think is most appropriate for your needs. And so that you're not overpaying for services that you don't want and need, but you are getting all the benefits that you do need whenever you want them, and they're there and available. And we think that it's just really important to emphasize the impact of lower fees and what that can mean over time. And this just tries to illustrate that if you had a £500,000 portfolio and you were looking at an annual return of 5% before fees, if you had all-in fees of 1.65% versus 0.85%, and 1.65 we see is a pretty common fee out there in advisors. In fact, when we look at traditional providers, anywhere from 1.5% to 2.5% is pretty common to see in terms of total cost of investing. If you look at that difference there of the 0.85 to 0.65, so 0.8% difference, over time, that makes a really big difference, a big impact. And we can see actually that if you're at the lower fee, the pot £500,000 has grown to 1.1 million. If you're at that higher fee, it's 966,000. So it's such a big impact that compounds over time. And you may not notice it, may feel like it's not that much of a difference, but period on period, this is one of the things you can control that makes a really big difference to your outcomes. So we really do think it's something to focus on. As Ian mentioned, inside the portfolios, we're always trying to keep the cost of investing as low as possible as well. So we will hopefully come in below those levels that we quote for the underlying funds, but it's something that we're really hot on, and we want to think about those elements that we can control. So pay fees where you should be for that expert discretionary management, for help with financial advice where it's relevant, but make sure you're not paying too much for those different services as well. So that's been an overview of how we think about financial planning, investment management, using technology to help you make the most of all the controllable things you can and give an insight into the uncontrollable elements. What I wanted to do now was just touch on some specific questions that have started to come through. And one question that perhaps I'll give Ian to start with was about staggering. So a client was talking about they had some cash today. Obviously, markets are a little bit tricky. There's lots of things going on. They wanted to know how we would approach going from having a chunk of cash to getting to aligned with their plan in the future.
Yeah, it's a great question. Thank you for sending it in. Our advice is always that if you're transferring from another provider, which a lot of people are doing, or maybe you're doing things on a self-invested basis, then it doesn't make sense to keep in cash for a prolonged period of time. If you have an amount of cash that you're moving from being uninvested onto an actual investment strategy, then we can also recommend a sort of a periodic amount of investment over time. So we tend to agree a strategy with the client whereby an allocation gets invested on a predetermined basis, just to avoid that idea of going from no exposure to 100% exposure when markets can be volatile. So it just takes out that point of timing risk, which Matt has touched on quite a bit previously.
Thanks, Ian. That's really helpful. And I agree. I think at times like this, a bit of staggering, if it's going to help you get to the point of being invested and combating inflation over time, it can be a really good way to be disciplined. We talked about behavioral biases. If you're trying to wait for the right moment to invest, it's so hard to call, and you'll either only realize it was the right moment once you've missed it, or you'll be kicking yourself for doing it. I think you've just got to set a strategy and move towards that through time and think longer term about your plans. And that's certainly how our staggered investment schedule works. Another one that's just for you, Ian, on the investment side, is a question about whether we have any active funds in our offering. I know you talked about active elements, but maybe you could just touch on why we predominantly use passive funds in our portfolios.
Yeah, sure. So the idea behind using passive funds is obviously the first one is that they just come at lower cost. And what we find is that for the vast majority of asset classes and the vast majority of time periods, the average active manager is just not able to justify that extra level of cost being taken. Now, it goes beyond that though. Historically, investors who are tend to be pretty smart people find it very hard to adjust their portfolio or their style of active management to changing market environments. So what we find is that active managers sort of quite often underperform even beyond that cost difference. Now, this isn't something that is set in stone. We sort of challenge ourselves quite frequently on it, and we also take a lot of effort to identify the particular instrument that we're going to invest in. So just say, if taking for instance European equities, there's a lot of different benchmark indices that you can choose to track. So we're always very conscious of the underlying exposure that a particular instrument might offer to us. There's a lot of due diligence that goes in ahead of time. All of that said, we have also historically, and do so at the moment, take investments in strategies which are not just naive market cap weighted, if you like. So for instance, in the US equity market at the moment, I spoke before about the valuation challenges of some of those large consumer technology names that dominate the market. We decided to try and dilute the risk of investing in those at the moment by introducing an ETF which gives exposure to all of the S&P 500 index, so the main index within the US, but do it on an equal weighted basis. So you still get that exposure to the US equity market, but in a slightly nuanced way. The same goes for within the high yield bond allocation at the moment. We invest in an instrument that's being run on a quantitative basis by JP Morgan, and they filter out some of the high yield issuance which has got characteristics that are unattractive. So whether that is the quality of the company that's issuing the bond, or again the valuation that's inherent in it. So we don't try and second guess the next star fund manager by picking active managers on an ongoing basis, but we have a very thoughtful process about how to choose an exchange traded fund that best fits the purposes within our overall portfolio goals.
Thanks, Ian. That's really clear. And I think it's one thing to note is that we do accept, though, that some clients will still want to have some active managers or other assets that are different to ours. We're trying to give you that core building block for your plans. And then you can still factor them into your financial planning using those wealth tracking tools and the financial modeling tools as well. To note, those are freely accessible both to clients and non-clients. If you register at my.netwealth.com, you can just go in and use those as a starting point without thinking about what you're doing. And then if you want to engage with us further, we're in hand to deal with that as well. Another question that came was about more of a specific of wanting to potentially transfer and how that process would work. One of the challenges right now is just making sure you're not out of the market too long. If you are fully invested, you want to transfer, the question here is, do we take care of that, and is there a process? Well, yes, absolutely. Once you've opened an account, if you make a transfer instruction to us, we take care of all the admin. You don't have to do anything after that point. You'll give us authority, we'll deal with that for you. We'll always try to minimize the amount of time that you're out of the market. So we'll only have portfolio assets sold down and transferred across once we're ready to receive them. In that part, we are always going to be chasing other providers as well to make sure they're dealing with it as quickly as possible. And we can also talk about specific strategies. So if you have multiple setups, maybe a pension and ISA, we might stagger the transfer. So we do the ISA first and then the pension, or vice versa, to try and minimize that impact through time. The aim is to keep it as a shorter period as possible so that you can remain invested in an appropriate way. But the key takeaways are that, yes, we'll take care of that. There's no charges or costs for us doing that on your behalf. And we'll try and make it as efficient a process as possible and keep that time frame as short as possible as well. So another question, Ian, that came in, and guys, please do keep sending across questions if you have them, was more of a general question about whether now's a good time for property investing versus markets and investing in markets. I'm going to start by just talking a bit about it from a sort of strategic position and how they might think, and then maybe you can give just any sense of a view for what it might mean from a sort of UK perspective.
Sure.
So if we're thinking about to sort of from a strategic position, you're probably going to continue to have some property. You probably have your own property that you live in. That's what we would often call a pot 3 asset. Just remember the characteristics of that it's going to be less liquid, that you can't just sell the bathroom to pay for a bill or so on. It's going to be harder to break up, and there's going to be more transaction costs and hassle. And so it may well be that property and other investments sit side by side depending on your setup and where you are, but making sure that you align for the different goals. So if you're in drawdown, property might not be as appropriate as if you're in an accumulation phase where you can benefit from things like leverage as well. There are some competing market forces that maybe Ian can talk about.
Yeah, sure. Well, it's a really interesting component, as well as people sort of thinking about whether it's best to invest in new property. Maybe they think that residential property has been through enough of a downturn so far, or maybe looking more broadly in our case at sort of commercial property. So a lot of people have been very keen on adding real estate of some form, which they view as alternative investments, largely because at times people think there's a bit of inflation protection built into these real assets. We haven't held any property for a period of time now. We find it difficult from a point of view of liquidity is the first point. Either you're investing in one of these sort of bricks and mortar assets that as Matt suggests, has that problem of a lack of liquidity. But if you're trying to translate an illiquid asset into a more tradable format, there are sort of listed property companies that a lot of people like, you tend to lose some of those inherent characteristics that you're originally targeting. Now, beyond those sort of structural challenges, at the moment, the dynamic between asset classes that are sensitive to inflation risk and how central banks respond in terms of where they set interest rates is really interesting. So the commercial property sector has really gone through a challenging period at the moment, and the yields on offer are creeping higher. But there still seems to be quite a disconnect between how people view the valuation of assets that they own and maybe people who are looking to buy into those assets. So before that gets resolved, we think that a lot of the value is going to struggle to get unlocked. But at some point in time, it's going to be pretty interesting, we think, and it's something that we look at quite closely on an ongoing basis. For us, it's probably still just a more of a cyclical asset class than something we would want to embed in our portfolios on a more strategic basis.
Okay, great. Thanks, Ian. I think we've got time for one last question, which is around advice and pensions in particular, and in particular around defined benefit pensions, and whether we give advice on that. So whilst we don't advise on a defined benefit transfer itself, in fact, our starting point is to say, let's think through the role of a defined benefit pension, generally a very valuable asset to have a guaranteed income into the future. Look at how that fits into your plans, maybe look at those modeling tools and understand what the impact of that is, talk through the pros and cons. Then if it is appropriate, we can introduce you to an advisor that is able to deal with that where appropriate, and we can certainly help if a transfer is appropriate and recommended with the investment of it afterwards. But broadly, we would want to start by making sure it seems like a sensible thing for you to do, because in many cases, keeping a defined benefit pension income that gives you investment return guarantees, gives you the protection against inflation, is a really great starting point to your wider plan, and it might help you be more thoughtful with other assets you have if they sit alongside those as well. But very open to having conversations about it. Will help you think about it and point you in the right direction. So if you do have specific questions on that, please just do get in touch at advice@netwealth.com. I think that's about all we've got time for today. Thank you very much for joining us. I hope you found it helpful to understand how we think about working with clients across financial planning, investments, and getting the most out of technology as well along the way. Please do get in touch if you'd like to discuss further. Advisors on hand. You can go online and book in calls, and you can also play with those tools, as I mentioned before, at my.netwealth.com. Thank you very much for joining us today.
Thank you.